I think the market's split between a March and April exit from negative rates. We're in the April camp. In the long term, it probably won't matter too much, and the discussion will move on to how high can rates go over the next couple of years. But in the short term, we think it's a bit more likely they wait till April. I think a couple of reasons mentioned in your earlier segment that the fiscal year end is coming up at the end of March. They also have an outlook report in April, which would give them an opportunity to explain the move in more detail.
Okay. It's interesting, right? Because what you're seeing in these wage talks seems to be quite strong so far, and maybe better than what we saw last year. Are you seeing signs of evidence of this virtuous cycle now, where you are seeing demand-led inflation really pick up?
It's quite striking. The wage ask from the Union Confederation is 5.9%, almost the highest in 3 decades. So even if that's not completely realized, we're likely to see a further acceleration of wage inflation among the unionized companies this year. And that should, as you said, get a more, in the Japanese case, virtuous cycle of wage and price inflation more sustained. I mean, that's really been the last missing piece for the BOJ, a sense that wage inflation is more sustainable and at a pace that can sustain service price inflation around the 2% target.
I mean, we were just talking about the sequence of events that could unfold, whether it's going to be yield curve control first, then exit out of negative rates, or is it just going to be ripping the Band-Aid? I mean, what do you think is likely going to be the case?
Our take is ripping the Band-Aid, as you put it, in April with both. At this point, the yield curve control's not really very binding. They've moved to a soft target. Rates aren't exactly on that target at any rate. So in that sense, it's more of a formality, we think, moving out of yield curve control at this point. The focus will be on negative rates. How do they characterize that? How do they characterize where rates could potentially go? Governor Ueda has generally been fairly cautious and suggested there would be a slow rise in rates, if any, beyond the initial exit. So our expectation is we won't see much more of an increase this year, perhaps only one more increase late in the year.
And we can't call it tightening, can we? Is this more just a normalization of policy, or can we actually consider it? And will the market see it as it that way?
Technically, it's a tightening, but as you said, we'd probably characterize it more as a normalization from this extended period of extremely unusual, very loose monetary policy. So this is really a milestone. Moving away from negative rates, Japan becoming more like a normal economy again with normal inflation, positive interest rates, modest growth, and obviously financial markets that are doing very, very well overall.
Is there a sense that you think when it comes to the economy, right? They talked about consumption being still weak. Do you think those real wages have still been on the decline? I mean, are we getting a sense that, these wage talks and the like and this virtuous cycle, could it actually lead to more consumer spending in this economy?
That's the hope. I mean, Japan's really quite different in this respect from most of the world. In most of the world, particularly most of the developed markets, we've seen inflation now come down faster than wage growth. So we're seeing positive real wage growth, and that's been supporting consumption in a lot of other markets. That's not the case in Japan, where wage growth hasn't picked up enough yet to surpass inflation, at least not meaningfully. This could change in 2024 if we see a further pickup in wage growth, with inflation coming a tad lower. Then we could be getting real wage growth in Japan as well, and that would support consumption in a way that we haven't seen as much over the past couple of years.
All right.